In my last video, how do we compare with an average Aussie, we discovered that there are big gaps between the super balance that we should have now in each age bracket. Have a comfortable retirement by age 65, which is about 690,000 for a couple and 595,000 for a single person. I know superannuation is not an exciting topic, but after we go through the 7 steps, you will realize there are only limited options out there, to be honest. So once we've set it up the correct way, you can let it run on autopilot and only give it a yearly examination. Sounds not that tedious anymore, yeah? So what are the steps to boost our super balance? Step number 1, check if you have multiple super funds. When you start a new job and you don't particularly tell your new employer which super fund you would like them to contribute to, they normally will set up an account under your name with their default super fund. So it's not surprising that you may have multiple super funds under your name. To find out how many super funds you have, you can simply log into MyGov, link ATO, and it will tell you the information. If you end up having multiple super funds, what you want to do is to consolidate them into one super fund because you don't want to see the multiple account fees eat up all the returns from super. You can simply do that on this page by selecting Transfer Super if your destination super funds is one of the current super funds. But before you do that, we must decide which super fund we like to be our final super fund. So step number 2, pick a super fund. ATO does have a function for you to compare super funds, but I found it little use as it only compares the default balance option, which is not suitable for most people. If you're not sure where to start, you may want to check this video in which I spent 10 hours comparing the major super funds and their best investment options. Hopefully that can provide some valuable information you're looking for. I'll put the link down below. And once you pick a destination super fund, you can use the tab of Transfer Super function if that happens to be one of your current super funds. Or if you pick a new super fund, you can either contact the new fund directly or fill out an ATL rolled over form and send it to your transferring from fund. While you do that, here are a couple tips that you want to keep in mind. Whether you choose a new super fund or one of your existing ones, let your employer know the super fund details so that they know the change when they do the next payroll. And don't forget to compare the insurance cover together with the fees and performance of the investment options. Typically, 3 insurances are attached to a super: life, total and permanent disability, TPD, and income protection. And will you still be able to get the same cover after changing funds? Or how is their policy look like for someone who has a pre-existing medical condition? Or lastly, how about the fees with the same amount of cover? When you examine the super funds, don't just transfer your super into the account with the highest balance. Maybe the small account is better super for you, or a completely new fund is the ideal option. You may know that there are 5 main types of funds: retail, public sector, corporate industry, and self-managed super funds. But in terms of the fundamental structure, a super fund is either an accumulation fund or a defined benefit fund. Unlike the accumulation fund, which is the majority super funds in Australia, with a defined benefit fund, you are guaranteed to receive a specific benefit when you retire, and you don't take the risk for the decline of investment markets. So please evaluate the pros and cons of leaving a defined benefit fund because you can't rejoin after you leave. Step number 3, start salary sacrifice. Until now, you should have consolidated your super funds into one that you're happy with, and it's time to think about how to contribute more to your super fund. The biggest tax benefit that you can take advantage is the concessional super contribution. This is the money that has not yet been taxed. Sometimes people call it before tax contributions, and these concessional contributions include the 10.5% super guarantee plus any salary sacrifice that you may direct your employer to put into your super. This is called concessional because the contributions are taxed at a special low flat rate of 15% within your super fund, which is lower than most taxpayers' marginal tax rate. Let's say in 2022-23 financial year, Mark earns $100,000 and his employer contributes $10,500 and himself made $5,000 as salary sacrifice to his super fund, and Mark's fund pays tax of $2,325. And if Mark didn't sacrifice $5,000, it would have been taxed at his marginal tax rate of 32.5% plus 2% medical levy, and he wouldn't be able to save $975 on tax. Of course, ATO doesn't allow unlimited concessional contributions. They have set a cap of $27,500 per year currently, and you will need to pay more tax if you contribute more. However, the exceeded amount can be counted towards any unused carry forward concessional contributions from up to 5 previous financial years if your total super balance at the end of 30th of June of the previous financial year is less than 500,000. And you can check how much unused carry forward concessional contributions from the MyGov website under ATO. Now, there is a Division 293 tax for high income earners. If your combined income plus concessional contributions are more than 250,000 in a financial year, you will need to pay an additional 15% tax on either the super contributions or the amount that is over the threshold, whichever amount is lower. For example, your income for this financial year is 240,000 and your total concessional contribution is 15,000. Division 293 tax payable is 15% on the lower amount of contribution, which is 15,000, or the amount above threshold, which is 5,000. If you want to start salary sacrifice, you can contact your HR. Depending on the super fund, they can either do it from the super fund management platform together with the super guarantee, or they might need your help to find your super fund's BPay or direct debit account and your reference number for salary sacrifice. Step number 4, make after-tax contributions. You can also make contributions into your super account from your personal bank account as long as you are aged under 75 years old and your total super balance is less than 1.7 million on 30th of June of the previous financial year. And these contributions are called non-concessional or after-tax or personal contributions because tax has already been paid from the money to contribute. And after-tax contributions are included in the non-concessional after-tax contributions cap, and this cap is currently 110,000 per year. If you're a high income earner, using after-tax income to boost your super seems to be silly. However, it still provides some tax benefit on earnings. If you use this money to invest outside of a super system, any earnings on the investments are taxed at your marginal tax rate instead of 15% flat. Any capital gains on investments held more than 12 months would be taxed at your marginal tax rate times 50%, which is normally higher than the 10% if held in super. And more money in super means more potential capital gains are tax-free when you enter the pension phase. And you may be able to bring forward up to 3 years worth of after-tax super contributions if you're aged under 67. Again, you can check out your unused after-tax contributions on MyGov ATO link. You can also claim tax deductions for personal super contributions, which will count towards your concessional contributions cap. However, before you can claim a deduction, you must give your super fund a notice of intent and receive an acknowledgement from your fund. If you want to make personal contributions to your super account, you need to transfer 1 week before 30th of June to make sure that it's received and allocated to your account by end of the financial year. Step number 5, make co-contributions if you're eligible. If you're a low or middle income earner and make personal contributions to your super fund, the government may also make a co-contribution up to a maximum amount of 500. Step number 6, make spouse contribution if you're eligible. If your spouse total accessible income is 37,000 or less and you make an after-tax contribution of at least 3,000, you'll be able to claim a full tax offset of 540. And check with your super fund as typically is a different account that you need to transfer the money into. Step number 7, review your super account. Once you've checked all the above steps, a regular check-in to your super account is important. For instance, does your employer pay you the correct amount on the compulsory super guarantee? Did they miss any transactions? And check with your employee if there's any doubt. If you confirmed your super hasn't been paid in full or your employer denies it, you can even report your employer to ATO and they will keep you updated on the investigation, including any recovery actions that they might be taking. And more importantly, you should check your investment option from time to time. Does the current investment fit my long-term financial goal? For example, if there is 30 plus years until I can access my super fund, is it really a good idea to settle down into a conservative balance option? Many super funds allow you to change your investment option by just a couple clicks once you log into your account. Finally, we should look at our insurance cover as the premium is deducted directly from the super balance. How much do I want myself covered for life and TBD insurance? Any of my circumstances changed since the last time I set it up? If my employer pays income protection insurance outside of super, maybe I can save this cost from my super fund. Although we're getting into boosting our super balance, I'm gonna announce a bad news. Yes, the 3 million super cap. Here is the thing. Recently, the federal government has proposed to introduce an additional new tax of 15% on the earnings from individual super balances above 3 million. If this gets passed, unrealized earnings will then be taxed. And this will be a radical change in the tax system because tax is currently only applied to income received and capital gains realized. And super is already not an attractive early retirement tool for people in the FI community, as money is locked away until it's too late. But if this proposal is passed and applied for the 2026 financial year, I think it will discourage and make many people rethink if superannuation is even an effective tax entity to plan for normal retirement. We'll see what happens. My name's Irene. I'll see you next week. Bye.